Hi, this is John Ntende. I'll be your associate tutor during this session of ACCA F5 Performance Management, where we shall be looking at risk and uncertainty, which is a key topic area and a decision-making part of the syllabus. So our scope today, we'll look at risk and uncertainty and what it means. We shall briefly look at what a payoff table is. Then we shall review some of the decision rules under conditions of risk and uncertainty. So we shall look at Maximin, maximax, minimax regret, and expected values. Then we shall look at other decision rules. We shall look at decision trees. We shall look at sensitivity analysis. We shall look at simulation. So risk and uncertainty. The key difference for purposes of F5 is that you can assign probabilities to a risky event, whereas you can't assign probabilities with any degree of accuracy for uncertain events. So in real life, the terms are used interchangeably, but for purposes of F5, that's the key difference. So briefly, let's look at what a payoff table is. So a payoff table is a matrix which is showing different profit figures for different projects. In this case, we have projects A, B, and C, okay, under different scenarios. So you have scenario 1, scenario 2, and scenario 3. Now, these scenarios could be the demand conditions, okay. So in this case, for instance, if you choose project A and the demand condition is 1, then you make $100. So if you populate such a matrix, this is something which is called a payoff table. In your exam, it won't be given. It is expected that you know how to construct a payoff table. We shall look at a detailed exam question in our next tutorial. But for now, let's assume that we already have this payoff table. So we want to look at something called Maximin. Maximin, the easiest way to remember this is we're trying to maximize the minimum possible outcomes. So basically, it is the best of the worst. The easiest way to remember Maximin, it is the best of the worst. The risk attitude is that this guy is a pessimist, okay? This guy generally fears risk, so he wants to maximize his worst possible outcome. So he wants to get the best of the worst. So let's see how we can use Maximin decision rule to choose the best project. So what you do is you take each project in turn. Now going down, we realize that the worst possible outcome for project A is 20, which you put down here. You create a different row. So you do the same thing for B. The least possible outcome is 10. And for C, the worst possible outcome is 60. So you choose the best of this. So you can make a loss of 20, okay, a profit of 10, or a profit of 60. So clearly, the best project to choose is C because it maximizes the worst possible outcome, which in this case gives us 60. So project C is the project to choose when you're using Maximin. So how would this come out in an exam? One, they would give you a long scenario and would expect you to come up with a payoff table. Once you come up with a payoff table, they will tell you to choose the best project using the different criteria. For instance, in this case, Maximin. You would do this. Then eventually they will tell you to talk about Maximin, what it is, where is it used, and what's the risk attitude. So what is it? It is the best of the worst. When is it used? It's used in conditions of uncertainty. And what's the risk attitude? The risk attitude is this person is risk averse or is a pessimist. So simply that's what Maximin is. So let's look at the reverse of this, which is maximax. This is an optimist. This is an aggressive person who wants to maximize his returns on any investment. So if we use the same payoff table, clearly the best figure here is 100 for project B, rather project A. For project B it is 120, and for project C it is 85. So clearly the best project to choose in this case is B. Please note the maximax decision rule is not 120, it is project B. It is the decision to make is to choose project B because it maximizes the return. So project B is the best possible project, which gives us the best of the best. So what is maximax? It is best of the best. What is the risk attitude? The risk attitude is risk aggressive. So this person is aggressive, so he's an optimist, he's a risk taker. So that's the risk attitude. Then we look at something called minimax regret. This one is someone who is called or usually referred to as a sore loser. So this person doesn't want to take a decision and then feel bad for not having made the best decision. So the easiest way to illustrate this is using an example. So same payoff table. In this case now we need to compute something called a regret table. We need to come up with a regret table. So the best way to look at this is for each scenario, we figure out the best possible outcome. So under scenario 1, the best possible outcome is 100. Under scenario 2, the best possible outcome is 120. And under scenario 3, the best possible outcome is 85. Okay? So the regret will be equal to the best possible outcome for any given scenario minus the actual outcome. For instance, how did I get 0? This 0 here, right here. The best possible was 100, okay? Minus the actual outcome was 100. So if I choose project A and the demand conditions are actually 1, that means I've actually made the best possible decision under scenario 1. So I don't feel bad if I choose project A and the scenario which comes up is 1, because there's no other better decision I would have made. But let's say I choose project B. Okay? The profit under B is 80. Okay? But had I chosen project A, I would have made 100. Okay? So you can see that 100 minus 80, okay, gives us 20. So the regret for choosing B and scenario 1 is the outcome is 20. So similarly, the regret for project C under scenario 1 is 40. So the same thing, the same principle will apply. For instance, the figure down here, 75. 75 would be the best scenario under 3, which is 85, minus the actual outcome for B, which is 10. So 85 minus 10 gives you 75. Same thing for C. If I choose project C, but the scenario 3 is what actually happens, then what this means is that I don't regret anything, because when I choose decision C under scenario 3, I don't regret anything, because it's the best possible decision I could have made. So once we do that, now we run down each project and figure out what is the maximum regret. The maximum regret. Okay? What is the maximum regret? So once we have the maximum regret, clearly what we're trying to do is minimize. We don't want to feel bad, so we choose the project which makes us feel the least worse off even after making the decision. So in this case, that project is C. Okay, so minimax regret, we are trying to minimize our regret. We don't want to feel very bad for making the wrong decision. So in this case, the project which minimizes the regret is project C. Okay, let's move on to expected value. Now with expected value, the risk attitude is risk neutral. Expected value is used usually for long-term projects or for repetitive projects, and it's used in risky conditions. That means we can attach a probability. Okay, so same table, but this time I'm attaching a probability to the different outcomes. So scenario 1 has a probability of 0.2 occurring, scenario 2 is 0.7, and scenario 3 is 0.1. Remember, the summation of the probabilities must equal to 1. Okay, so the probabilities must equal to 1. So we want to calculate the expected value of each project. So what is expected value? The expected value is equal to the summation, okay, of probability, okay, times the outcome. So expected value is the summation of the probability multiplied by the outcome. So in this case, to get the expected value of project A, okay, I'm going to multiply 0.2 by 100 plus 0.7 by 90, subtract 0.1 by 20, because this 20 is a loss figure, as you can see right here, to give me 81. I'm going to do the same thing for B. Okay, so you can see 0.2 by 80, then 0.7 by 120, then 0.1 by 10 to give you 101. So you can see the 101 right here. So the expected value is the summation, okay, of the probability multiplied by the outcome, which in this case is the profit. Then expected value for project C will give me 80. So under expected value, what we are trying to look for is the project which maximizes the expected value, and in this case that project is project B. So expected value is equal to the summation of the probability times the outcome, okay, the event. The risk attitude is risk neutral, and when can it used? It's used in repetitive circumstances, and usually it's used for long-term forecasting, and it's not appropriate for one-off events. So that's the theory which would usually come up on decision making. So let's move on. There's something called decision trees. So what is a decision tree? So a decision tree is you're trying to make a decision, okay? So for instance, okay, you're trying to choose between B, okay, and C. If you choose B, you may have an outcome of D and an outcome of E. If you choose C, then you may end up with F. So a decision tree is drawn from left to right, and you try to put in all the alternatives into the decision tree plus all the corresponding probabilities. Now to make the decision, okay, in this case whether to choose B, okay, or C, we shall have to evaluate the expected value, EV of B, okay, and the expected value of C. And remember, expected value is equal to the summation of the probability times the outcome. So for instance, the expected value of B, okay, expected value of B, okay, will equal to the probability of D, okay, times the outcome of D plus probability of E plus the outcome of E. So that would be the expected value for B. So similarly, you calculate the expected value for C, and the decision to take would be the option which has a higher expected value. So a decision tree simply is used when we have risky scenarios and want to evaluate the different scenarios. So as I told you, you draw the decision tree from left to right, but the evaluation is done from right to left. Of course, we shall look at a more detailed example on how to draw decision trees and how to evaluate, but the basic concept is you choose the project or the branch with the highest expected value, as we've already seen. Value of perfect information. So what is perfect information? Perfect information is taken to be 100% accurate, so meaning we can rely on it to make future decisions. So it's 100% accurate. So what's the value of perfect information? The value of perfect information is the difference of the expected value when we have perfect information, okay, minus the expected value without perfect information. So that gives us the value of perfect information. But what does this mean? It means that value is the maximum amount we should pay for perfect information. So for instance, if there is a firm or a company which wants to do a market research and tell us that their results are very accurate and they're asking for a certain amount of money, how would we assess how much we should pay them? So we would assess that by using the value of perfect information, which is the difference between the EV with perfect info less the EV, the expected value, without perfect info. And that's the maximum value we should be willing to pay for that information. So that is simply it. We shall still look at a detailed example of how to apply this. Next is something called sensitivity analysis. So briefly, what sensitivity means is that we have a certain project and we want to analyze the sensitivity of certain variables to that project. So sensitivity of a variable is simply the percentage change required to reverse an outcome. So in this case, usually, for instance, the reverse of a profit will occur when you start making a loss. So the point we're interested in is when the profit is equal to 0. Because at that point, that will force us to change our decision. So let's look at the basic example and illustrate how to calculate the sensitivity of a certain variable. So here you have a simple example of a project whose sales are 4,000, variable costs are 3,000, fixed costs are 800, and we're making a profit of 200. So the question is, can we try and figure out what is the sensitivity of this project to fixed cost? Now, to reverse the outcome, this profit right here must go to 0. So as you can see right in this illustration here, so this profit here must go to 0. So for that to happen, the fixed cost must increase by 200. So sensitivity analysis assumes that all other variables remain fixed and only one variable is allowed to change at a time. So that's one of the key weaknesses of sensitivity analysis. So to get a profit of 0, if these are fixed, then we need the fixed cost to equal to 100, and clearly it is a balancing figure. So the sensitivity is the percentage change which has occurred in the fixed cost. So our new fixed costs are 1,000. The original fixed costs were 800. So as a percentage, we end up with 25%. But what does this mean to management? So for instance, if you have two variables, in this case you have fixed costs, which is 25%, and let's say the sensitivity of the variable cost, now this is just an assumption, is 10%. Okay, so you can see that the lower the percentage, the higher the sensitivity the project is to that specific variable. So if the variable costs had a sensitivity of 10%, that means that the variable cost would need to increase by 10% before the project makes a loss, whereas the fixed costs would need to increase by a much bigger value of 25% before the project makes a loss. So if you have so many variables, from a management point of view, it is important to focus on the variables which have the highest sensitivity to your profit figures. So if you have a variable whose sensitivity is just 1%, then you must closely monitor it. So that's what this means for sensitivity analysis. But once again, the key assumption of keeping all the other variables constant is one of the biggest challenges of sensitivity analysis. Now briefly, simulation. Now you wouldn't expect a detailed computation of simulation, but the basic idea is that simulation models can be used to deal with decision problems involving a number of uncertain variables. So we use a computer to generate random numbers, which we then assign to these variables, and we come up with all sorts of profit scenarios. So simulation, all you need to know is what it is, but you wouldn't expect a very detailed question on simulation for your exams. So we've come to the end. Briefly, let's recap what we looked at. We looked at risk and uncertainty. Risk, you can assign a probability. Uncertainty, you cannot assign a probability. We looked at the payoff table, which is simply a matrix showing the decisions on one axis and then the possible scenarios on the other axis. So the matrix would usually be populated with a profit figure, but it could be another figure like contribution or any other variable which management is interested in. Now we looked at some decision rules. One, if you remember, we looked at Maximin. Maximin is best of the worst. The risk attitude was risk averse, and the conditions when it's used was uncertainty. Then we looked at maximax, which is best of the best. Risk attitude was aggressive. Then we also looked at minimax regret. This is someone who doesn't want to feel bad for making a bad decision. And remember, we drew a regret table, and then we found the maximum regret for each probability, and then we chose the project which had the minimum of the maximum regret values. Then we looked at expected value, where we defined expected value as the summation of the probability times the outcome, which could be the profit figure. Then we looked at other decision rules. We looked at decision trees, which is used together with expected value to try and evaluate all possible scenarios out of making certain decisions. We looked at value of perfect information, being the difference between the expected value when you have perfect information minus the expected value of perfect information. And we defined perfect information as being 100% accurate. Then we looked at other decision techniques. We looked at sensitivity analysis, where we defined sensitivity as the percentage change in a variable which will change the outcome of a certain project. Then we looked at simulation, where we're assigning random numbers to variables and using computer models to evaluate key projects. So once again, I've been John Ntende, your ACCA tutor. Please give me some feedback. My email is john.ntende@gmail.com. Otherwise, I wish you the best of luck in your exams and nice reading. Thank you.